But from the Chinese perspective, and Russia's too, if you look at how the US has weaponized the dollar, has weaponized what used to be considered neutral infrastructure like the SWIFT system, etc. Even FX reserves being confiscated. They don't want to hold them anymore. So you are starting to see a gradual, inexorable move towards barter.
On today's episode of What the Finance podcast, I have the pleasure of welcoming Michael Every, who's global strategist at Rabobank. So, Michael, thanks for joining the podcast today.
Yeah, you're very welcome. It's nice to be here.
Yeah, and I really look forward to our conversation because I think since the start of the year, so much stuff has happened from a macro perspective, from markets perspective. It's geopolitical. It just seems like it's been a very busy year so far. So, from your perspective, what are you currently watching, and I guess what have you seen as the key drivers for the start of the year?
Well, what I'm going to say isn't particularly original to begin with, but I hope it will become more original as the conversation goes on, in that I was a very, very early drum beating out one message, which was that everything was going to become about geopolitics. And if you didn't understand what that meant, you were going to be absolutely wrong-sided by things. That's pretty much now the standard market motto. But where I think my research and my view differs from most others, not all others, but most others, is that I think they don't actually understand geopolitics. It's very, very easy to reel off as a phrase when you work in markets. Oh, yada, 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 geopolitics. But a lot of people use it like the bogeyman. It's just this mysterious word that you throw in when you want to talk about something abstract that's either an excuse for why you got everything completely wrong, or is a very loose answer to a question that you otherwise, can't give a decent response to. I try to be a bit more granular than that where I can, although there are limits to that, obviously.
Yeah, definitely. So I guess, can we start, in your opinion, what is geopolitics and why do so many other people get it wrong?
Okay, well, the simplest definition is easy. It's world politics. So it's what happens in other countries affecting you. That's always true if you think about it. If you live next door to a country and they vote for a massive tax cut, that's going to be inflationary and stimulatory. That flows through to your own economy, your own society. So we're always interconnected. But the way that we look at it nowadays, I think it's basically shorthand for a more unpleasant world, shall we say, where, dare we whisper this or not, financial markets aren't the most important person in the room, where someone in a uniform might be, or someone with a gun or a bomb or a rocket might be, where no matter how much money you've got, it doesn't do you any good. And no matter how much influence you think you've got in certain circles, it doesn't count for anything. That's what I think people imply by geopolitics. The reason they don't go into it in great detail is they haven't studied history, usually. They haven't studied political economy. They haven't studied political philosophy. They haven't studied any geography. If you haven't studied any of those, let alone strategic studies or really looked at the realpolitik of how the world really works, if you haven't studied any of those and you're a product of an economics background, I really question how you can understand these things, because economics as a mindset is all about avoiding zero-sum equations. It's all about win-wins. It's all about, all boats rising, which is not how the real world works, not how economics actually works most of the time. And it's only when history comes and gives a short, sharp kick up the backside to, this market miasma that they suddenly realize again, for a while at least, goodness me, there are more important things than me in the room. But they've got such a big ego that doesn't last very long.
Yeah, I can definitely see that. So, if we look at, I guess, from your perspective, why you thought this was going to be an issue earlier than other people, what led you to believe that? You've mentioned history. I guess, what things were you seeing occurring in our world that sort of reminds you of the past and thought that we were going to see this massive, I guess, shift?
Well, this isn't a new view in that I've had a similar stance for decades, to be honest, but I knew it would be a slowly unfolding picture. In that I've been lucky enough to live and work in 9 countries around the world, which gives you a lot of different angles of looking at things. Working in one is great. If you worked in 2, it's fantastic. You think you've seen 2 sides of a coin. When you've worked in many, you really understand it's a multi-sided shape. It's like a dodecahedron. And the world is much more complicated than people think. So that's a personal perspective. Secondly, I've always been interested in history. I've always been interested in politics. I've always been interested in realpolitik, and have lived in some countries where you get planes flying overhead and bombs going off, etc. And it gives you a much different view than if you've lived in a nice, comfortable, safe country where the most annoying thing is that maybe your lunch is delivered a few minutes late while you're working in the office talking about world politics, which is frankly a lot of people working in very spoiled backgrounds, from very spoiled backgrounds, working in very spoiled markets. So that's kind of a personal bias. But professionally, if we go back all the way to the early 2000s, I was a very early adopter of a heterodox school of thought within my professional lens kit, shall we say, the different lenses you can put on to look at the world. And I guess you would categorize me loosely as a post-Keynesian, for those listening who are familiar with that particular terminology, which is basically a mercantilist. That's what I think we end up being at heart, not because I like that point of view, but because if you look at the long run of history, you can see that's where we always end up. That the current market paradigm that most in markets still think is the norm, even if they write and say they think it isn't in their heart and the brain they think it is that it's a win-win, lifting all boats, free markets work best, and that basically neoliberal economics internationally is what will be the panacea that will get us through everything. And if you look at history, you see that just isn't true. You get winners and losers within societies, you get winners and losers between societies. And I was calling the GFC before the GFC happened, not by that name. I was a pretty junior analyst making a pretty big call. And I didn't have any money to put behind it like Michael Berry. So if you watch The Big Short, I was one of the guys writing reports saying exactly what they were saying. But, I didn't have any money to put behind it. And I just got very frustrated and quit before the GFC happened, just thinking I don't want to be here when it does. But when it did, and then we saw the reaction in terms of QE, money printing, bailing out the rich, socialism for the rich, kicking the can down the road, it was always just a question of time until we got the angry backlash. And I knew that was going to arrive in various different ways, shapes, or forms. But I thought one of them would end up being in terms of a nascent populism of different sorts that would say, look, we want to try something different. Lo and behold, a few years later, you end up with first Brexit and then Trump. Neither of which came as a surprise to me. At the beginning of 2016, I published a report called Thin Ice, in which I said globalization was on very thin ice. It looked a mile wide, but it was an inch deep. And history showed you we could go right through, which was as close as I could get to saying in public, don't presume that Brexit will fail or that Clinton will win. Keep a very open mind to the possibility that the other happens and changes everything. So that was from the Western side. And from the other side, it was very obvious that the tensions with China were absolutely going to escalate because, China does a lot of things right that we do wrong, and some things wrong that we do right. We can all learn from each other. But it was obvious that America in particular was going to turn around and say, let's make things in America again. And the UK would try and say the same via Brexit and fail. And Europe would eventually say the same things in Europe. And everyone will say the same things. And we end up with mercantilism. Now, I can be more mathematical about it. I can go through the balance sheets and explain how this all works. There are lots of different angles one can explore. But the nuts and bolts of it are that. And once you accept that, you realize that there are knock-on effects to all manner of different asset classes. The strategy that you should undertake is very different from one where you presume that a rising tide lifts all boats and it's win-win.
Yeah, it's fascinating to hear. So if we look at what we have today, as you said, a lot of these countries are looking to, onshore, friendshore, all those, buzzwords that are going around at the moment. I guess, how would you link that to mercantilism? And then from there, how do you see it impacting, I guess, the global relationships? We've already seen it with the China-US trade war and other concerns there. What impact will this have on, I guess, the relationships between these countries?
Well, it can only be antagonistic unless you end up with a managed trade environment from a political perspective, which again is the long run history of trade. Most of the time it's managed by some power saying in order to prevent too much destabilization in our society, or between our societies. So you can't do too well, we can't do too well, this group doesn't do too well, that group doesn't do too well. You have to moderate things, you have to balance them out. Where we see that happening, we can expect massive realignment. Where that happens antagonistically, you will get clashes, you will get higher tariffs, you will get higher subsidies, you will get protectionism, and alongside that, naturally, you will have either stagflation before you get lowflation again on the back of it. Because eventually, if you do build up enough capacity in an industry, for example, if we build up enough capacity to say we don't want Chinese steel, we can build it just as cheaply at home on our own scale, which, okay, in steel would be hard to match, but in some products, possibly you could get there, and or we will subsidize them. You can eventually end up, with what you could call a more resilient supply chain at a lower cost, but getting there will be very expensive for a number of years. It will absorb labor, which means unemployment is low, which means wages go up, which means inflation stays high. And that's part of the price that you pay. If you want to have really, really low inflation, you have to go along in first order with this neoliberal globalized model. But to do that, you end up with some countries being the net exporter and some countries being the net importer. And it doesn't work if you don't trust the net exporter or you don't trust the net importer. And because of the imbalances that have built up, we no longer trust each other. Ergo, we will go through this painful 2 steps forward, 1 step back process of trying to make supply chains more resilient, onshoring where we can with subsidies if necessary, nearshoring where we can't. And that process itself will have many stages as we move to one country and then we find out, oh, actually, they're still getting the inputs from China. We need to move further again, or we need to move the inputs one by one out of China. It will be a multi-year, maybe multi-decade process during which inflation will be higher than we are used to. So yes, antagonistic, difficult, not one that investors are used to, because all they want to hear is, when do interest rates go back down so I can make some easy money?
Yeah, and do you think there's a bit of naivety, I guess, in terms of, as you said, it's going to cost a lot, it's going to have high impacts on inflation, on wages, etc. There's almost a bit of naivety that this can all be done quite easily, I think, from maybe business people and politicians as well, maybe the general public. Are you seeing that? Or?
Oh, very much so. I mean, look, you can point a finger at me, and people do, and say I'm naive for thinking that people will vote to decouple, to onshore, reshore, nearshore, whatever you want to call it, because everybody just wants cheap stuff. Everyone saying that is so dyed in the wool in neoliberalism, they just can't conceive there's any other way of doing things. It's very insidious, that you don't even recognize it's changed your thought process. To that, I always say, how much work did you do over the weekend, or how much trading was done on Saturday and Sunday? And they'd always say, well, none. I'll say, well, who decided we don't trade on Saturday or Sunday? It's much more efficient if we traded 24/7. If all of us worked all the time till we dropped, think how much more trading we could do. No, markets close because we need the break. And, that started from the Old Testament. But the whole point is society and beliefs are imposed on markets. That's the angle that I'm taking. Now, you can say I'm naive for thinking that will apply here. Okay, fair enough. Certainly the people who think this will be easy are just as naive, because it took decades to set up the very complex integrated supply chains that we have. And we're not going to do that in reverse in 12 months. It's probably going to be 20 years. But is it happening? I'm absolutely convinced that it is. There's an overwhelming preponderance of evidence that, at least in terms of US-China, it's happening. But it will be a multi-stage, multi-geography process that will continue to shift and pivot along with changes in geopolitics. So as you see election results shift, as you see the overall drift in policy towards subsidies, tariffs, and industrial policy, which is now officially American policy again, which I predicted years ago, by the way. Black and white in print, I said that's what they would go for. I was patted on the head and told that's naive and ridiculous. And I said, and India will be making iPads and iPhones. Again, patted on the head, never going to happen. That happens in China. What's happening now? So they're naive for thinking it's quick. Maybe I'm naive for thinking it's going to happen at all. You can also say we're naive for thinking this will be a peaceful process. Because, political economy, if you start thinking we've moved from a world of Karl Marx, where capital does well by suppressing labor, and therefore you have low inflation, low wage growth, low interest rates, high asset prices. A lot of validity to that view. I had that view for a very long time. But remember, Marx himself was superseded intellectually by Lenin, who was prepared to use extreme political violence to try and make the revolution happen faster than history wanted it to. And Lenin said late stage capitalism sees more monopolies, which we've got, more oligopolies, which we've got, attempts to try and carve out new markets around the world, which we've got, oversupply, which we have. And it ends up in imperialism, spheres of interest, and war. And you have to say there's, a worryingly strong historical echo between the present moment and 100 years ago, when Lenin was arguing this, just over 100 years ago. So if you take that long run historical perspective and a bigger picture one and a cross-disciplinary one, which is the stance I overtly take, it doesn't mean everything's written. I don't believe there's a textbook or a series of Da Vinci codes that will tell you what is going to happen. I just keep an open mind, and I don't presume that everything's about trying to get a cheaper widget, which is what it used to be about. And if it isn't about that, everything else changes in terms of how you have to invest.
Yeah, it's really interesting. So if we look at, I guess, the past 30 years, what's really seen as product inflation decrease massively, potentially deflation. I think they call it the classic Walmart cost, which is basically the China inflation because of most of the products are from there. But then services have really increased massively over the past 30 years. Do you see a sort of a bit of a switch, or could it be just as services continue to increase and then products increase at a similar rate or higher than they have over the past 30 years? How do you see that happening?
It's a great question. Look, it remains to be seen. On one hand, you can make the argument it's pretty hard to deflate services. Whereas we do know that goods inflation is going to be structurally higher going forwards. Yes, you could temporarily have a dip towards lowflation again because of base effects. And if you get that, all the people I'm calling naive will be waving flags and saying, look, I won for 6 months. You haven't won anything historically. It's going to be very hard to replicate that China price. If we're going to have resilient, diversified supply chains where you have 3 or 4 suppliers, not one, and 3 or 4 markets you sell to, not one, it can't help but be more expensive. If you're going to nearshore or onshore, it will be more expensive. And that will generate more local production, which means higher wages, which is positive, which is more growth, which is, again, more inflation. So I'm thinking we go back to a goods price on average, using America as a benchmark, if I may, something like what you saw in the 1980s. Now, in the 1980s, you had globalization. Absolutely, you did. But it was a fraction of what you have today. The durable goods price over a 10-year average in that period in the US was around 4%. That was your average 10-year inflation in durable goods. Now, prior to COVID and the stimulus and the Cold War kicking in, the new Cold War, we were just about 2%. So we're talking about goods basically doubling, I think. So then you're going to have services really, really low to have a 2% inflation target met going forward. Now, potentially, artificial intelligence might get us there. Maybe. Because a whole swathe of services jobs might be done better by computer. And if, by the way, if you think your job can't be, it's a job that AI can do. That for me is a litmus test of whether you're ahead of the curve intellectually and understanding what this technology could or couldn't be if it keeps developing at the exponential rate it is at the moment. But let's presume we have legislation put in place to stop that happening, which could do the trick. For example, if they say that any sign whatsoever that an AI is using a global database of other people's proprietary data means you can sue them. Well, that would be the equivalent, for those who have read Dune, I don't know if you have, of the Butlerian jihad, which occurs in the background to Dune, which is why that science fiction book and movie, there are no computers. That's why they have the guys called mentats who do all the mental calculations in their head, because they had AI in the past and the intelligent robots tried to kill mankind, Terminator style. And everyone said, no more of that, thank you. We won't allow a computer a computer in the form of a human brain. We won't allow that to happen, or a human mind. So if we can't deflate on services, I think the best we can do is to try and bring down asset price inflation, which flows through into a lot of services. Like if house prices are going up and up, you have much more expensive holidays, you have more expensive manicures and pedicures, all the kind of services flow from that because everyone's feeling asset rich. which used to be the compensation for being income poor because of low goods prices. So if we're going to start seeing higher goods prices, potentially we're going to start seeing wages go up from a low base and at the low end of the socioeconomic pyramid where they've been hard done by for decades. Good. I don't have any problem with that. Anyone who has a problem with that really isn't a fan of stability in their own society, because we can see how fractured our own society is becoming. But if that's going to happen, we have to deflate somewhere. So I would suggest, yes, that's going to be a bad time for asset inflation. And all the people for the last 40 years who have thought all the money is made with money or buying a property or 2 or 3 or 4 or 5 or 6 really could be in for a short, sharp shock. Because we've already seen what's happened on rates. We can already see the pain that's being experienced, near term. But how many people do you know telling you personally or writing it in markets that don't worry, rates will come back down again in 12 months, in 6 months even, they'll be much lower. And all of this was a nasty experiment, which isn't going to last, and we'll go back to where we were. That's still the market mantra. That's still the market meme. When that disappears, goodness me, in terms of, the shock that will be like the worst of 2002. Again, the cold, hard realization you could potentially have a 5% plus interest rate for year after year. So I hope that's answered the question. I may have gone on too long in doing so. Apologies if so.
No, it's a great answer. And I'd be really interested in hearing your thoughts, because I guess if you look at, it's probably a bad time for asset prices to go down because so many people are retiring and many of them are relying on those asset prices to basically get them through that retirement. So do you see, I guess from government's perspective and central banks, their probably goal is to try and inflate them as high as possible so they don't have to pay out as more pensions, but that might not be possible.
I've heard that argument many times, and it always sat badly with me, because when you think about it, okay, let's split assets down into 2 broad categories. First of all, housing. Sure, okay. But you're not going to sell your house when you're older. You might pass it on to your children. And if house prices are collapsing, well, okay, if they're collapsing for your children, they're collapsing for everybody. I'm not forecasting they're going to collapse. I'm just, speaking hypothetically. So housing would feel like a blow. And unless you're doing a reverse mortgage as a retiree, I simply don't see how it affects you if all you're doing is passing it on as seed capital for the next generation. So that's housing. If you're talking about equities, sure, you don't want the valuation to be collapsing, right? But at the same time, if you can manage to lock in a decent interest rate, surely that's got to be good for you. So the annuity you get when you trade in the pot at the end is going to be higher than it otherwise would be. Because otherwise you're having to do all the lifting in terms of asset price appreciation to compensate for the fact that the annuity is just going to be rubbish. If when you retire, they say we're going to give you a 1.5% annuity, you have to have saved vastly more than if they say we're going to give you 5. So again, I think there's some wiggle room there. But lastly, if you do actually need to sell those assets to retire, you're actually selling stock portfolio. If it's really unaffordable, how are young people going to buy it? If it's just incredibly high, where do you expect the next generation to have the money from to do it? So even if you want them to be high, where does this money source come from to allow everyone to bid it up? Some people might say, well, QE. Okay, fair enough. But been there, done that, got the t-shirt. And a lot of people say QE is money printing. It isn't. Money printing is useful. If you print money, you get inflation, and you start having a kind of boom that you got during COVID. Now, too much of a good thing, sure, but goodness me, did it generate an impulse in the economy, giving people money to sit at home? QE is like printing money and only giving it to one guy who sits on it like a dragon, doesn't share it with anybody, and just use it to speculate on the price of certain assets, which makes everybody who doesn't have them poorer. So it's like useless money printing for idiots, which is of course why we did it.
Yeah, definitely. That's a great way to put it. So if you go back to geopolitics, you mentioned that there could be potential for quite a big conflict. And I guess you also mentioned there the potential for a second Cold War. So I'm not sure if you want to maybe go more over that. Do you see that there's the risk that, I guess, similar to what we're seeing with Russia, Ukraine, where Russia's been cut off from everything? Do you see the risk of that happening with China? And then from there, if I guess the Cold War would happen either or, but then what would be your thoughts on the Cold War?
Well, we're already in the Cold War now. I published a piece late 2017 using Soviet propaganda posters as the backdrop for my graphs and charts, basically saying it was absolutely unavoidable at that point if you looked at the ideological drift in China, which, by the way, was a response to the fact that its own economy displays a lot of the problems that we have in the West. It's not as if they're this pure, lean, mean Marxist machine. There's an awful lot going wrong there, where they've got too high property prices, too much inequality. They've copied a lot of our problems, and they were saying so openly. So on one level, I said there was a problem on that side, and on the other, as I already alluded to, I said the West was going to start mirroring the Chinese response of saying, right, we want to onshore, bring jobs home, etc., etc., etc. And it was inevitable you'd end up with a clash, and that both sides would try and mirror each other in a defensive manner, which would be a downward spiral. That economic war is taking place right now. The White House may not call it that because it's impolitic to do it, but that's where we are. Everyone with a brain can see that's what's actually happening. It's certainly what the Chinese can see. They say that they're being contained, like Japan was before it launched Pearl Harbor. That's the language they're using and the kind of the analogy they're making. That process will continue to see 2 steps forward, 1 step back. De-risking, which is actually decoupling, which is actually deglobalization to a degree. And again, that flows through to far more things than people realize. Because, just a sidebar for a moment, you didn't ask the question, but we have to go there before we come back to the last part. People say that won't work in America because they rely on foreign capital. You hear that all the time. How are we going to cover the fiscal deficit, etc.? You know, with the debt ceiling in the background today. You really don't understand the issue if that's how you frame it. Because China produces more than it can consume. The same is true for Japan, the same is true for Germany to a degree. All these are big net exporters. If you're a big net exporter, by balance sheet definition, you produce 100 and you consume 90 and you export the 10. So you have net savings. You're saving more than you spend. You're producing more than you consume. What do you do with that net saving and that net production? They're both the same. The net saving and the net production are the same. The net saving and the net production both have to get sent to a country which has the opposite, which is America, which has net imports and net dissaving. So you create the imbalance in America by the fact that you are saving and producing too much. If China stopped doing that, America would, and everyone else did too, America would start to see less capital inflow and a smaller trade and current account deficit. And the economic growth would lift all boats and it would have a smaller fiscal deficit or a larger private sector surplus. So that would affect the flow across all kinds of assets too that people don't see. So this economic war can disrupt far more flows than people think just in terms of changing where a factory is located. No. It flows through everything: asset prices, FX, rates, all things. But to come to the last part, just very briefly, because you could do an hour conversation just on this. Sure, there are tail risks of war. Of course there are. You don't have to take my word for it. Look at the editorial in the Financial Times today from Gideon Rachman saying that war over Taiwan would undo 40 years of progress in China. Look at other Financial Times editorials. Look at Adam Tooze writing in Foreign Policy. Look at the Wall Street Journal. There are very serious people out there with very serious connections making very serious statements about how much they fear that tail risk and how much they worry that on the current trajectory, it's almost unavoidable because China sees itself as being contained, which from their perspective it is. And the US sees itself as needing to contain China because it can no longer sit within the economic system it helped create, where it is continuously deindustrialized and polarized. And yet pushing back on that will break all manner of things, as I've just said. So it's a deeply concerning time. And I think, people who refuse to see this, or who just keep saying, well, don't worry, rates will come down in 6 months and then, yay, good times are back. It's just ridiculously naive. It's almost comical. And if people are managing someone's pension fund thinking like that, what are you doing? What are you doing? Do a bit more reading, do a bit more worrying, please, because, the current backdrop deserves that respect.
Yeah, there's so many great points. So if we go back to what you were saying, I guess, about the surpluses and how that has to be invested somewhere, and normally it is in treasuries, US treasuries. There's been lots of talk about, I guess, de-dollarization and the fact that, some of these countries are going away from the dollar. So do you think is there going to be a need for, I guess, another asset? So maybe Chinese bonds or other assets for these surplus countries to invest in to then maybe go away from the US dollar? Or do you see that happening? Or do you think what our current system at the moment is just going to continue to move as it is?
Again, that's a really great question that gets to the heart of a lot of what is going on around us. The global system is the US dollar system, as we all know. The fact that it is reflects what I just said a moment ago, that the US buys the excess production from everybody else. Net, that's where it all flows. If that breaks down, if the US stops doing it, they don't have that surplus. They have very high unemployment and too much stuff, or someone else picks up the baton. So it's really important for the global network, such as it is, that the US keeps consuming, and others keep producing. But that is breaking down because the US doesn't want to keep consuming. It can't do and maintain its military hegemony going forward. And without that, the system collapses historically. We see that time and again. So that's a dynamic, again, you could have another discussion about. But from the Chinese perspective, and Russia's too, if you look at how the US has weaponized the dollar, has weaponized what used to be considered neutral infrastructure like the SWIFT system, etc. Even FX reserves being confiscated. They don't want to hold them anymore. So you are starting to see a gradual, inexorable move towards barter. What you're seeing initially at the moment is countries netting out their dollar flow. Like, instead of me sending you $100 and you send me 150, we'll do what banks do and net it out to 50. So you drop from needing $150 in the two different countries to change hands to just 50. That's a sharp decline in dollar usage globally, but you still price in dollars. Now, therein lies one crisis. All the euro-dollar debt that's out there, which is the offshore US dollar debt, no one even knows how big that is. You can make a guesstimate, including derivatives and trade commitments, which are still dollar priced at, say, 50 or $60 trillion. So twice the US economy, with no central bank backing it up. So if we reduce the dollar flow between countries, but all that debt is still there needing to be serviced, tick tock, tick tock, tick tock, something's going to go boom. And yet it doesn't even stop there, because the countries are saying, well, we're still sending the 50. The only way to get rid of the 50 is if I sell a bit more of this to them and they sell a bit more of that to me, and we rebalance the physical flow of goods and services into new groupings and new clusters. Maybe we use even fewer dollars. And the next step beyond that is to say, how about using alternative? That's where it falls down, because at the moment you've got two, hypothetically. Number one, you've got the renminbi, which has got the scale, because China is huge. It's got the commodity appetite. It's everywhere. The problem is nobody wants it. Nobody wants the renminbi because they have capital controls. It's a deeply politicized currency, where if you're worried about the US weaponizing what they do, yeah, enjoy the renminbi, because they would never weaponize the renminbi, never. You'd never have a problem with the renminbi asset being a safe receptacle. Absolutely, your government could do whatever it wants, and your holdings in renminbi wouldn't be touched, and you can note the sarcasm in my voice. But if they don't open that capital account and they continue to insist on running a current account surplus, a vast current account surplus, you can't even earn renminbi. So the only way you can get renminbi out of China is twofold. Number one, you do trade and business with China, but you end up borrowing more and more from them, in the way that Greece was borrowing from Germany within the Eurozone continuously, and everything looked great. But how did it end up for Greece? Well, that's one perspective, and historically that was called empire, by the way. Now we call it the euro. I'm joking, but there you go. And the other one is if China uses swap lines, which is what it's starting to do, where effectively you get a currency swap between two central banks of two different currencies, and then that renminbi then flows back again. That's the same thing. China is effectively doing vendor financing. But again, it's getting its hooks deeper and deeper into countries in the same way that people accuse America of doing it with dollars. So if we're not going to go that route, then you have to say, what else? A commodity? Can we use gold? Well, yeah, we could, but gold has no yield, no flexibility. You can't create more of it. And if you want a zero-sum world where you have winners and losers, that's gold. Anyone who looks at the history of gold will show you those who have got it do well, those who don't suffer. And everyone has to wear a hair shirt to try and get more gold, which is zero-sum. That's going to create much more geopolitical tension. And crypto is digital gold with an unlimited supply. So it's stupider gold. Like, it's just absolutely pointless gold. So there's nothing I can see, but that doesn't stop some countries talking about trying to shift to a basket of commodities. The BRICS economies, Brazil, Russia, India, China, South Africa, for example, are talking about trying to form something new, where a weighted measure of the commodities they produce will somehow be put into some new BRICS coin, which they will use for external trade while they use their own currency domestically. Now, can all this be done? Yes, it can. Is it staggeringly complicated to the point where it will disincentivize international trading? Yes. Is it stable? No. Will it still happen anyway as America moves in one direction and the rest of the world politically wants to decouple? The risk is still yes, it will. And that ends up with a fragmented global system with fragmented supply chains from upstream to downstream for fragmented consumers on fragmented payment systems. And we saw that in the 1930s. It's not science fiction. It happened in the 30s. We were already heading towards war in the 30s. We didn't know it. But if we move into that system now, it may allow us to stabilize without war. It may accelerate it like it did in the 30s. I don't know. We should all be worried by what's going on rather than pretending it isn't, which is most people in markets, or screaming the dollar's done, buy renminbi, buy the ruble, buy gold, buy crypto. On the other hand, both of them are very naive stances to take.
Yeah, so trying having that more nuanced take on what's happening. So for what I've been hearing, as you said, people should be more worried about what's happening in the world. They should be more cautious, I guess, in terms of their investing. So from your perspective, what do you think will perform in the coming years? From what I'm hearing, it's probably going to be value investing. We're sort of going to go back to that, I get cash flow generating companies are going to be the ones that people are going to probably should be holding. What are your thoughts on that?
Well, that flows from another thought that I've got that I'd like to share. I'll be brief. And that is that historically, and even currently, most people think policy has to operate on a continuum where you go from high rates, medium rates, low rates, negative rates, QE, QE++, QE+++, et cetera, et cetera, et cetera. What I actually think right now is we have to see a mutant or a fusion hybrid policy. We are going to have very high rates for some sectors of the economy, similar to what we have now, because they're irrelevant in a Cold War. They're just not needed. You're allocating capital and manpower and technology to frivolous irrelevancies. I mean, I made the joke a few weeks ago, what if we try and create a new Instagram filter that makes cats look like dogs? Yeah, I'm sure loads of people would use it. What's the bloody point? We're in an economic Cold War where we're fighting over supply chains of basic commodities, and we narrowly avoided freezing in Europe this winter, only because we had a very warm winter. Otherwise, people would have been shivering, maybe sleeping in their offices. We were talking about that as a fallback option, in internal discussion. So why the hell do we need that kind of absolute nonsense? Equally, if we cut rates, that's all we're going to get. So what we need is very, very low rates for the important parts of the economy, which is going to be supply chains. Let's be blunt, the military-industrial complex. Anything that's resilient, infrastructure, that needs very low cost of borrowing or even no cost of borrowing, and it needs to be done now. You could say the same thing about green investments. Don't project, a 40-year time plan for a project which you need for the next 7, and then you hope you can mothball. Maybe we desperately need it for 7 years to keep social stability, and after that we have to write it off. That can only be done with ultra low borrowing costs or QE. But very high rates for anything that's irrelevant. And that is how we used to do things prior to the Big Bang, market liberalization in the 1980s and globalization, and one interest rate for all, and markets flowing from one country to another to chase who had a higher or lower one for carry. Everything was segmented. This sector is important. You borrow cheaply. Hypothecated credit. No, you're not important this year. Credit rationing. You don't get any money. Now, will mistakes be made if we do that? Absolutely. Is it a perfect system? No, but it's better than what we've got now. which is either nothing or too much of all the wrong things and the right things. So I think that's where we're heading. And if you want to invest, you have to understand which are going to be the sectors that are going to do well. Don't put your money in a sector that's irrelevant, because it's going to be choked off. Unless it's got the free cash flow you're talking about, it can't be leveraged up. It will die. And when you're looking at the sectors that are going to do well, yeah, they're going to be the ones the government wants to do well. But maybe they won't generate that higher return. It's entirely possible the highest return will be on a treasury yield, something like 5.25%, because the government wants you to put your money in safe hands because they know where the money should be going. But then the private sector, which is going to want to build Instagram filters turning cats into dogs. So if you grasp that mindset, you start to see very different ways of looking at what you should or shouldn't be investing in. And we're not there yet, but I do believe that will be the emerging pattern.
Yeah, it's really interesting points. And I think it's something that, is being talked about more, financial repression. I guess you could even say government's actually, backing loans to certain industries. And, we've already seen these green grants and these semiconductor sort of bills in the US. So there's, we're seeing it now. And as you said, it could spread to more of those industries that are going to be vital for the future.
How do we not do it? Let me flip it around the other way, because I have this discussion with people regularly, and I get the resistance because you're talking about going back to a world pre-Bretton Woods 2. You're talking about basically the Bretton Woods world of, capital controls, rigid limits on what you can do internally, managed trade. The follow-on from that, by the way, is fixed exchange rates, is what we also used to have. We had fixed exchange rates for decades under Bretton Woods. I think there was a 20-year period where the Italian lira didn't move against the US dollar once. And then it did. Can you imagine? You went for lunch and you missed that one trade and that's it. Your whole career's over. But anyway, we're talking about, in some respects, mirroring that. But you're trying to tell it to people who work for an industry which has grown enormously bloated, buying and selling things of no relevance to each other and presuming this actually matters in a world of finite resources, and where things like Nord Stream can be blown up by, someone. Doesn't matter whether it was the Americans or the Russians, regardless of who you believe. Someone blew it up. And that's the world we're living in. And you think you can get by buying something digital on a screen, which doesn't exist, and selling it to someone else on a screen, which doesn't exist. And from that, you can make enough money to get someone to give you food and somewhere nice to live. It just doesn't add up. So if you understand how desperate the world really is, you start thinking, no, we're going to have to go back to this, which will really shake things up. And I do believe we're already there. If you join the dots, why, for example, has the Fed been so aggressive on rates? Not just because of headline inflation. Why is it also now saying hedge funds have to report loss-making positions after 3 days? Maybe they want to have a little word in hedge funds' ears about what they do and don't invest in, and what trades they do and don't do. Why is the IMF's World Economic Outlook for April talking about how over-leveraged some global commodity traders are? That's shadow banking. And these are the guys who are neck deep in potentially trying to back that argument between commodities and the dollar as the funding, the bottom tranche for the global funding pyramid internationally. Is that pure coincidence? They're pointing out that they could be a target for the Fed and regulation. Why are we now seeing JP Morgan buying up some small banks, which even the Pentagon said were national security, like SVB? Check the headlines. The Pentagon said they were watching that bank carefully. And why are we getting BlackRock stepping in? We couldn't get any more establishment in the US, and saying maybe we're going to help backstop lending for small banks, because small banks are a very important part of the US economy, but only if they lend the right way. And if you want to introduce the kind of political economy I'm talking about, you can't have 4,000 small banks all doing their own thing and be on the phone to 4,000 people all day saying who you're lending it to. You need to have a conduit to make sure that you understand what they're doing. What's the game plan? Which is the sector you should be lending to? And it's much easier to do if there's fewer of them and they're scared and they're reliant on a bigger player to be giving them overarching guidance. So look, maybe I'm reaching for too much here. Maybe I'm adding 2 and 2 and making 22. I'm prepared to accept that. And it's not palatable to people who see everything in neoliberal market terms, even if they don't call themselves a neoliberal. But I suspect this is the game being played. If you join the dots, I think you can see the pattern. And I certainly don't see how the alternative is any kind of viable strategy from a governmental perspective. If you're running things, tell me how you think cutting rates again, blowing an asset bubble in stocks, pushing up house prices so that young people will never afford to buy one ever, and expect them not to vote for radical parties of the left or the right, or to say, I'd rather help China or Russia in the Cold War. You just tell me how this works, because I'm all ears and I don't hear it.
Yeah, I completely agree. So, Michael, thank you so much for your time today. We've covered so many topics. My last question is, what is one message you'd like people to take away from our conversation?
It's a great question again. Do a bit more cross-disciplinary reading, please. It's not so much a question. I'm questioning you. Keynes himself said, if you're only an economist, you're unlikely to be a good one. And I think that's really true. It cannot hurt to learn some history, some political science, some philosophy, anything, some hard science. Go and learn something else. Put it alongside your economics and see if it doesn't make you a better economist or a better market strategist. I bet you it does.
It's a great point. So thanks again for your time. So if anyone wanted to find more about your work and what you do, where would the best places for that be?
Best place to start is on LinkedIn. I'm fairly active on that, and you'll often see some of my latest thoughts there. If you like what you see, reach out. Let's have a discussion. I have an open door policy in terms of conversation with interesting people.
Yeah, perfect. I'll put that in the description below, but thanks again for your time.
Thank you. Have a great day.
Thank you so much for listening. And if you enjoyed the episode, please subscribe and click the bell icon so you are notified when new podcasts are released. I hope you're leaving with some great value about investing, trading, and finance. See you on the next show.